Welcome back. We're going to continue on our trading system development, and we just want to kind of remind everybody that trading is not a marathon. Trading is a marathon, not a sprint. Meaning, you're not going to pick all this up on one watch. You're not going to pick all this up in 5 minutes. It takes time. As we are talking with chart patterns, the key to chart patterns and all of trading is recognition, pattern recognition, and that takes time to where all these patterns get into the back of your brain, and when they start forming, you're able to see them. And as we move on to our next part of our foundation, it's going to be the same thing. We're going to be using uh, technical indicators as a part of our trading, but how you interpret them becomes easier as you interact with them more because they're natural. That's why you see basketball shooting, baseball players hitting, all this practice for the game, so that when you're in a live situation, the game slows down. So again, this video we're going to focus on technical analysis. We've already done chart patterns. We're going to do technical analysis here, and then we have two more sections. As a part of this video, we're also going to talk about market internals. And of course, I want to remember that one of the things that sets Accendo traders aside from some of the other systems you'll buy out there is that we are not a buy and goodbye program. There's a lot of information here. The key to you watching these videos is to build that foundation so that when you come to the training webinars that you have access to, we can build upon that foundation and grow your knowledge and grow your skills over time. This is not a sprint. This is not the 100-meter dash. This is a marathon. So, technical analysis. What exactly is it? Well, in short, it's a way that we use to measure the price action of a particular investment vehicle, a particular stock. It's a mathematical study of the supply and demand, the buying and the selling. And we use it to help make investment decisions and to help identify a trend and whether or not that trend is going to continue. Some indicators allow us to understand the emotions of the market, especially when we get to the market internals. But when you get to true technicians, they're more interested in the price than they are in the indicators, and we'll talk about that more. So even though we're talking about technical analysis, and we're going to talk about a bunch of indicators, remember that the primary thing that you need to understand are those chart patterns and the price action, because all technical indicators lag in some form or another. Some lag more than others, but all technical indicators, because they're a response to the movement in the price, there is a lag there. So that's why understanding price is far more important than indicators. But there are some indicators, when used properly, that can be a great asset to your trading skills. So technical indicators come in several categories. First one most people know about, moving averages. Then we have volume-based indicators, price indicators, volatility, and then we have our market internals. Some call those sentiment indicators. So what about those moving averages? Well, they're probably one of the most widely used because they're very easy to construct, very easily to interpret. They're a smoothed out version of price. They help form a trend. Moving averages are a lagging indicator. One thing you also see with moving averages is that they're the building blocks of other indicators like Bollinger Bands and Keltner Bands. And the two most common types of moving averages you're going to find out there are simple moving averages and exponential moving averages. Again, moving averages are an average of the price over, in our example here, the past 50 days or the past 200 days. The exponential moving averages are the same thing, however, they're weighted. A simple moving average just takes the average and plots it. The exponential moving average takes what happens in the most recent past and gives it more weight than what happened 50 days ago. So it gives more credence, more value to what happened yesterday than what happens a couple weeks ago. there are arguments on both sides of what you use, and I use both. So really, again, this is when that we talk about the art of trading. It's really what makes you feel good inside. I really don't think one's better than the other because it's all about how you're interpreting price as it is anyway. When you get to know your stocks, you'll find that some stocks interact better with simple or exponential or 10 or 20 or 5, whatever moving average. And so you really need to get to know the stock or your investment vehicle, options, futures, whatever it is, and find out what they like, exponential, simple moving, or the different time frames versus focusing on one or the other. Now, moving averages, one of their great primary functions, and one of the ways I use them is for identifying the trend. You can see in our example here, as long as the stock is above this moving average, it's considered an uptrend. And when we cross below the moving average, it's now a downtrend. We cross back up, it's an uptrend. So a rising moving average is considered an uptrend. A sloping down moving average is considered a falling moving average, and the price is falling. Some people even put multiple moving averages. We saw the 5 and the 200 before. We have the 50 and the 200 on this one also. Not the 5, but the 50. And when the shorter time frame crosses above the longer time frame, that is considered bullish. That is, and some people use it as actually as an entry or an exit signal. When the longer time frame is above the shorter time frame, crosses above, then that is considered a bearish signal. So in this example, we have the shorter time frame of 50 crossing above the 200, so that is a bullish signal. And if the 50 moving average would break down below the 200, that would be a bear signal. And if you're long, you would like to get out. Also, we like to use moving averages as support and resistance. Remember, we talked about trend, and as long as it's slipping up, it's an uptrend. Whereas the price comes and bounces of the moving average, that is considered support. And as the stock now is below the moving average and we're in a downtrend, it now becomes resistance. And what you'll find is that the moving averages act as magnets. So what about volume-based indicators? The thing that's great about volume indicators is that you can get more worth out of the move. If there's more action in that particular investment vehicle, there's more volume, then that means that the buyers and the sellers, the traders of that stock or option or whatever it may be, are putting up their dollars saying, yes, I believe in this move. They're saying, yes, this move is valid and we believe in it. So when you see volume increasing, you want to put more weight into what direction it's going. Some examples of volume-based indicators are on balance volume, accumulation distribution, and the Scheichen money flow. I don't really use those too much. When it comes to volume, I really like to use the market internals. Now, price-based indicators are the most popular. These, again, are going to be the simple mathematical calculations that are trying to interpret the recent price action. Of course, you can tell what's going on by looking at the price, and then you can see down with your price-based indicators sort of a confirmation of what you're already seeing in the chart. But remember, they are a lagging indicator. So price may already be moving in a different direction, but the indicators may be lagging behind and still giving you a false signal. Normally they're shown below the charts, and there are some, very common ones that most traders have in their arsenal one way or another. RSI is the relative strength index. MACD is moving average convergence divergence. Slow and fast stochastics, the commodity channel index, which is CCI, and the average directional index is ADX. Now, the three musketeers, the holy grail of indicators, are going to be your RSI, stochastics, and your MACD. And basically, what you're going to see is when these are low, you buy, and when they are high, you sell. I mean, that's a very general sense of the rules. We're not going to talk about the 20 and the 80 or the 70 and the 30. Just in general, Uh, when they are low, you're buying, and when you're high, you are selling. Overbought is when we're high. Oversold is when they're low. MACD, you're trading the crossovers, and you're trading the angles, and you're trading the location of high and low also, but you're also looking for that crossover of the MACD. So let's take a look at these when we use them in conjunction. And again, when I'm looking at an investment vehicle long term, I really do like the three Musketeers, stochastics, RSI, and MACD. And when they line up, for example, right about here on Thursday, we're looking at an hourly chart here. You can see stochastics are high, cross over to the downside. RSI is high, is crossing out of overbought down, and our MACD give a crossover. And what happens to price? It goes down. Does that happen every time? No. But when you get your indicators in agreement, you're setting up your probabilities. Remember, trading is all about probabilities, defining your edge and putting you in situations where you're likely to succeed versus trading blindly. Similarly, you can see we get a crossover to the upside, RSI coming up, and stochastics coming up, and price goes up. Now, of course, we had a big up day there also. So when I'm using these, I typically like to use them in conjunction, and I typically like to use them in longer term time frames. However, I do like stochastics on my intraday trading of futures. I still like the overbought and oversold signals. I have a variation developed by Dave Elliott, First Wave, that I use, and they give me signals, and you can kind of see when I got my red arrow, that's when it went down. Got my green arrow, that's when it went up. I'm still a little lagging, but I do like to use stochastics in my intraday trading. That's one of my primary indicators that I like to use when I'm trying to set up my probabilities, trying to set up my edge for trading. Next, we have CCI. And CCI is great for trending markets, and it's used to identify cyclical turns in the market. When we have a nice trending stock, we use CCI to stay in the trade and find ways to get back into the trade on pullbacks. We use buy and sell signals as the indicator goes above and below 100. 100 on the top side, negative 100 on the bottom side. A bullish signal is generated when the indicator goes above 100. Now notice that as long as it's staying above 100, we have a nice strong uptrend, and so we should buy the stock or the investment vehicle right about here, and as long as it stays above 100 right about here, you stay in the trade. As it breaks out, we have an entry for you to take your profits, or you can stay in. Once we break above 100 again, we get a move up. Break above 100 again, we move up. And the reverse would be for the downside. When we break below negative 100, that is a strong downtrend, and that is a sell signal. Now, the other thing that you might notice is that if you were to draw a line a little bit clearer through here, you would see the opportunity to see a bow and arrow. And when CCI breaks below it, many times it would actually snap back up, especially in trending markets. That's why I'm saying CCI is great in trending markets. Let's take a look at that. Now here we are. CCI is another one of the indicators I like to use in my intraday setups along with stochastics. And you can kind of see that we have three CCI. We have 5, the 20, and the 50. And what I want you to show is the green and the red one is the 5. And notice that when it comes up and gets away from the two longer terms, the 20 and the 50, that's when the price retraces back up. But then, again, with that bow and arrow, it snaps back down. And this is, again, I'm using some Dave Elliott terms here. I don't want to take credit for that. Dave Elliott terms. It snaps back down. The price snaps back down. And as it stays down here below negative 100, that's what he calls zoom zone. And it price zooms right on down or up. So again, you can see here on the 5-minute time frame, the short term moves up, forming that bow and arrow form, that triangle, and it pulls back down, and price pulls back down. As long as the the three are under that negative 100, the price really moves down during that time frame. I know I want to keep saying that I know this is a lot of information as we continue to try to build the foundation, but keep in mind there are live training sessions that we're going to reinforce everything that's being taught in this video. This video is for you to watch over and over again to build a foundation so that we can, again, strengthen those skills, strengthen your toolbox as we get together as a group. Another indicator we can use to measure the trend is ADX. And ADX also gives us a value from 0 to 100. See, ADX does not tell you whether or not the stock or whatever you're looking at is bullish or bearish. It is measuring the strength of the trend. It's telling you whether or not this move up or down is strong. Remember, volume is one way we look at that. ADX is another way. And basically, anything below 20 says that we're not really doing anything. When we can get above 40, that indicates a strong trend. So as this line starts going up, so does the price. As the line starts leveling off, so does the price. And it starts to come down, and the trend starts to come down. Now, notice, though, that as it's coming down, ADX has not turned, so it's currently indicating that this down pullback is not as strong as of yet. Now, we can look at this on a larger chart here, and another thing we can use for most all indicators is divergence. When ADX doesn't make the same high, price also doesn't make the same high and goes down. When it starts showing strengthening trends here, that's also where we get a little leveling off here. But because the red DMI is above the green DMI and ADX continues to get above 40, notice when we get above 40 here is when we really start to accelerate and move back down again. What about some volatility-based indicators? They help us to confirm price behavior and help us identify breakout range and also help us identify extreme prices. Some of the common volatility-based indicators that we're going to talk about are Bollinger Bands. Many of you have heard about Bollinger Bands. Keltner Bands look very similar. And then I've been talking about Dave Elliott, and he developed what are called Momentum Bands or MoBo. Many of us know about Bollinger Bands, nothing new here. They are involved standard deviation and moving average. So the outside bands usually are two standard deviations, 20, and we have a 20 moving average inside of it. Some people accelerate it, some people change the numbers. That's how Dave Elliott changed and created his MoBo bands. But basically, you have two standard deviations and a 20 moving average. And again, the upper and lower band indicate that two standard deviation. What you need to know is this. There are two ways to play Bollinger Bands. One way is, notice how the price rides right along the bands. So that is called walking the bands. And it comes down, test moving averages, it comes back up. The minute that it pulls off the bands and goes back up, this is going to be your short entry to come down. And this is basically called playing the bands. As it reaches the extreme top, you can short it and let it come down to extreme bottom. And this still would have worked, but it didn't go all the way back at the top. But you can see here, it went from the top to the bottom. The other thing we're going to look at is, you see right here, we can see the price is flattening out. And so the bands flatten out. And this is called a squeeze. And usually when you get a break above the bands now, that is a breakout. And so when price breaks outside of the bands, that is either a buy or a sell. Whether or not it breaks out above or breaks out below, those are also buy and sell signals. The Keltners are going to give the exact same setups. You can see here, when price breaks above the bands, that is a sell buy signal, and when it breaks below the band, that is a sell signal. This is also measuring the volatility of the stocks. Also giving overbought and oversold signals. What you'll hear a lot of people talk about are Keltner days. The price breakout is what we just talked about, and the overbought and oversold is, again, on Keltner days when the stocks are just trading in a range. When you hit the top of the band, sell. When you hit the bottom of the bands, buy. Those are Keltner days when we're just kind of bouncing from band to band. Now, MoBo bands, as I mentioned, are a variation on Bollinger bands developed by Dave Elliott. He's known as First Wave at WallStreetTeachers.com. And what's different is that instead of trying to capture the move inside the bands, he wanted to get rid of those noise, and he has now moved his bands inside of the move. And what that allows you to do is to stay in the trade longer, because now it becomes sort of a support and resistance type indicator. So you can see here, once we broke above the band, so this is the breakout. MoBo bands are breakout signals. You're not going to do the band to band like you do with Bollinger Band and Keltner's. This is a breakout. So once we break above the MoBo band, we stay in that trade as long as it stays above the bands. And once we break it, you need to consider taking profits. And then once we break to the downside, that's a breakout to the downside. That is an entry signal, and we get a move down. So MoBo bands are for breakouts, not for playing the band to bands. So that leads us to the conversation of which one to use. So on these narrow range days, you want to look for overbought and oversold levels. So therefore, you want to use Bollinger bands or Keltner bands. That's what we're saying, Keltner days. However, when the market is really trending, you want to find and identify breakouts. So now you want to probably use the momentum bands or use Bollinger bands and break and Keltner bands when you break above those bands and use those as breakout signals. And also, we'll be talking about later about a price action channel. The last section we're going to cover is market internals. This is the last section of the technical analysis, technical indicators. And what market internals do is give us a way of analyzing the number of stocks that are advancing at one point in time compared to the ones that are declining. Again, it's a tally of how many stocks rose versus how many have declined, and it gives us a way to measure the mood of the market. We use it to identify market sentiment. We give it to give us an overall gauge of whether or not the buyers are in control or whether or not the sellers are in control. And once again, we calculate it by identifying how many issues, how many stocks are closing higher versus how many are closing lower. And there are several types. There's up volume, down volume, advance and decline, tick, new high, new lows, VIX, several various types of market internal indicators. So the first we're going to talk about is that up volume versus down volume. And we have a picture over here, and just as the name indicates, it's an analysis of the up volume market, how many buys are coming in, minus how many sells are coming in, down volume. Remember, we already said this, price action always rules, but this gives us a good glimpse at the health of the market. Now, I look at this in two different ways. One way is I have the plot. I'm plotting the line of the up volume, and I'm plotting the line of the down volume. And what this helps me do is identify a ratio of how much is going on. But the other thing it allows me to do is to look for a divergence. I mean, if the up volume is moving high like this, but price isn't, that tells me something. And that's why I also look at it this way, just to give me a good trend. But when I look at it on the right, the two rights, the top one being the NYSE, the bottom one being the NASDAQ, this doesn't show me the actual, this shows me the actual value of up volume minus down volume. But this shows me the ratio. And this also helps me, again, identify divergence, and also shows me that, up volume is really kicking it right now, 3-to-1 compared to down volume. Advanced decline, you notice I have the same way here. And this looks at how many stocks are advancing versus declining. When you look at a stock internals, they classify stocks in one of three ways. First, is the stock advancing right now? Did it decline right now? Or is it remaining unchanged? It gives us an overall look at how the market is doing. It helps us spot trends or false trends. And it tells us how many stocks are actually taking part in the broader move. So if we're declining, more stocks are declining than advancing at one time, but the prices are going up, you can probably tell, again, we got divergence. And it's a false trend, and we got to be prepared for the market to reverse. Now, many of the internals play a higher weight in futures and forex compared to general stocks, but it's still important for general stocks, especially for day traders. Next, we have new highs and lows. I'll be honest with you, new highs and lows is something that I use end of day and on the weekends. Then I use intraday, but it's something to know. And just as it says, this is a calculation of how many stocks made new highs compared to yesterday versus how many stocks made new lows. Again, another gauge at the strength of the market. What about VIX? VIX was created to calculate the implied volatility of the S&P 500. It's a tool for measuring the fear in the market. So when the VIX is high, that means the market is fearful, and typically that means the market is going down. And when VIX is low, that means the market is kind of feels good with itself, and typically the prices are advancing. Right now, and this is 2010 June, VIX above 40 means we're going down. 30 20s, we're pretty much okay. Low teens, we're going up. Now, one of my favorite marketing tools to use is tick. And tick is the number of NYSE stocks upticking versus downticking stocks. Again, as with all market internals, it's a way to gauge sentiment. And traders use tick in various ways. They fade the extremes, they use it to confirm direction, and they do what we call tick hooks and tick fades. And also, Dave Elliott, first wave, his group created an indicator that measures how many ticks it's going to take how many ticks are going to occur in 1 hour. And that, again, shows me volume of the trades, volume of the NYSE. So this is good because if we can see that we get a higher reading, when we see fades, that's about fading the extremes. When we get to a high number, typically that means in general sense that the prices are going to reverse. When we get down here, that means prices are going to go up. And we can trade hooks. If the stocks are trending and you can get a pullback in a tick, you can trade that hook back up. But that's in a trending market. A lot of information. We're going to go over this more, but I just want to give you a general understanding of what tick is. The upticking stocks versus the downticking stocks at any one moment in time. So this is my actual screen of my market internals. And again, I really play keys to the right side compared to the left side. Upline, downline is important to me, but I think tick's very important, especially as a day trader, a future day trader. And advanced decline is very important to know what's going on with the actual strength and heartbeat of the market. What are some general trading rules for market internals? You should never base your trade based just on market internals. Again, it's just a gauge of the sentiment. They help confirm price move. If the market's moving up and we got high ticks and we got strong advanced decline lines, then you can probably see this is going to continue on. But they also can give us a warning signal that if the price is going up and yet advanced declining is starting to go down, then we're getting divergence and we have to consider that a reversal might occur. So, technical analysis review. Woo! That's a lot of information, wasn't it? Well, all these technical indicators can be placed into two categories, either a leading indicator or a lagging indicator. But keep in mind, all indicators are lagging. It's just whether or not they're really lagging or just a little bit lagging. We use leading indicators like stochastics to help us identify turns in the market. Remember I said I even like stochastics on my intraday trading on futures with price action. Lagging indicators are more about trend and help us follow the price action. With indicators, you want to look for divergence, and you want to make sure that you use the right indicator for the right job. And again, just with chart patterns, you got to spend some time, different time frames, different indicators with whatever investment vehicle you're using, and find out which ones work together and give you the best signals. Now, I have to be honest. It has been said that technical indicators are for the novice traders who don't know how to interpret price. And especially if you're a futures or a forex trader, a day trader, certainly price pays credence. That is not to say that you should not be using technical indicators, but what I do want you to think about is this. A lot of people can trade right off the chart. They don't even look at the indicators. Sometimes you even have time to look at your indicators. So what I want you to do is think about some simple things. Look at your chart, and can you identify support and resistance? I had a friend of mine, and we've been working together for a year now, and you know, that's the first thing we talked about. We didn't go to stochastic RSI. He came over, we put up a chart, and I said, is this an upturn or a downturn? And he said, what? So the things you need to do is, before you get to your indicators, is identify support and resistance. Draw your trend lines. Can you identify where extreme emotional changings could happen, where panic would happen, as Alex from PureTech would say? And then learn to interpret that price action. More importantly, this is where we're going to tie in our chart patterns. Use chart patterns and technical indicators in conjunction. And remember, it's always more important about the what, chart patterns and technical indicators, than it is the why.